stepped up basis. So this is something that not a lot of people are aware of. So what happens with stepped up basis? So we have something in America called estate planning. We have something everywhere called estate planning. So if you have a property, when you have a property and you leave it for your beneficiary, there is something called a stepped up basis. So whether that's real property, it's investment property, it's stocks and bonds, any type of property with gains on it, there is something, if you do not give it to them right away, as a gift, and it passes to them at death, then there is something called stepped up basis of an asset. This means that they can sell it at any time after you passed away, and their cost basis is the fair market value of the asset at the time of your death. So let's give you an example. Instead of what you paid for it, let's give you an example. An example is, let's say you have, I'm going to say a rental property, and you bought that rental property for $150,000. And with today's market, that rental property could be worth $500,000. So it's there, it's $500,000. Now you pass away and you leave that to your children. The advice for me is to always have your property appraised at the death of the owner of the property. So always have it appraised at that time, so you know what the value is at that time, because that value is pertinent information as to what your cost basis, you as the beneficiary, your cost basis is on the property. So you need to understand that number is really important. You have to have proof. So just in case the IRS asks you, why is that your basis? Yes, I had an appraisal done, or I did this, or I did that. This is what the cost of the property is now. So instead of let's just say the cost is $500,000, but your people decide that they're not going to sell it right away. The beneficiaries are not going to sell it right away. So they decide they're going to hold it for a year. And what about another $100,000? Now they sell it for $600,000. Let's say there's no selling expenses. Make this easy. So now their gain on the property is not the amount you paid for it minus less the cost of the sale price less the amount you paid for it. It is the sale price less what the value was at your death, at the time of your death. So that is so they're going to save capital gains tax on that piece of land for that $300,000 in between, or the 350. If you bought it for 150, it was worth $500,000 when you passed away, and now they're selling it for $600,000. They're only going to pay capital gains rate on that $100,000 because that is the appreciation between your death and the time that they sold it. This is a really, really, really great way to save taxes. So you definitely want to avoid capital gains tax on the sale of any type of property, whether it is land, it is investment, real estate, or it is stocks and bonds, any type of asset that has appreciated and then passed to your beneficiaries. You're going to save a whole bunch of taxes in between, because the cost basis is now stepped up to the time of your death, and that definitely works in your favor. Now, there's other things to consider, which because our estate tax levels have changed into the $5 and $6 million range. If your entire assets is over that amount, then you would need to consider estate tax at that point. But if it's anything below that, you will not have to consider estate tax, because you will still get the stepped up basis with the property. So this is a great way to think about whether you would want to sell your property before you die and take the gain then and pay the taxes then, your investment property, your land, your stocks and bonds, whatever it is, or you would want to pass it to your heirs and have them sell it after you die so they get the stepped up basis and they save all the taxes. So that is my last thing that I'm going to discuss with you guys today. This is the Modern Savvy CPA, and I just want to make sure I let you know, make sure that you are vetting the information that you are getting on social media and that you're getting in on the internet, or you're getting it anywhere. Just do not listen to anybody who is talking. If they're the loudest or you see their face the most, that does not mean they know what they're saying or they're qualified to be teaching you what they're saying. So until next time, this is Sherron from the Modern Savvy CPA. Thank you.